Good day to all. My name is Sheng Polun, iFAST Research Analyst. Global equities have done well in the second quarter of 2023, with the MSCI ACWI Index up 8.11% in SGD terms. In this quarter, Brazilian equities have performed well, and the critical driving force behind this momentum has been the supportive commodities outlook. With the promise of potential rate cuts and attractive valuations, there's further upside to be found here. Meanwhile, in India, India's robust recovery stands out from its Asian peers and China. However, steep valuations may limit the upside potential of Indian equities, especially when global economic growth is slowing. There is a high risk for valuation compression given the elevated valuations. However, long-term growth prospects of India remain intact due to favorable domestic factors and proactive reforms, and investors can keep it on their watch list. Over in the land of the rising sun, Japanese equities market is no stranger to currency fluctuations. A weaker yen has been a blessing in disguise, boosting earnings from foreign ventures. However, fear not, for even a stronger yen should not deter Japanese equities performance. In fact, it could help to quell market risk, like the trade deficit and corporate headwinds. Although investors have been optimistic for China at the start of the year, it has not played out well so far, as China faces several daunting macroeconomic and structural headwinds. For investors keen on Chinese equities, they can consider the A shares. They typically have larger allocation to state-linked enterprises and are poised to benefit from policy tailwinds. Meanwhile, the Thai market has underperformed due to an outflow of foreign funds and weakening Thai baht post-election. Looking ahead, the tailwinds of tourism and private consumption will help to fuel this nation, keeping on a steady trajectory upwards. Last but not least, the spotlight shines on Malaysia, where palm oil production and the labour market are picking up steam. A recent pullback in Malaysian equities has drawn keen investors, eagerly eyeing a potential entry point. And that is all for this quarter's best and worst performing equity markets. See you in the next quarter. To get a full analysis, scan the QR code or click on the link in the description below. Next, Dejun will share with us about US Fitch rating. Over to you, Dejun.
Hi everyone, I'm Dejun from the iFAST research team. In a stunning turn of events, Fitch Ratings made headlines on August 2nd after it downgraded the US government's credit rating from the coveted AAA to AA+. This downgrade, while not immediately catastrophic for markets, raises important questions about the country's financial future and calls for investors to tread carefully. Fitch's decision to lower the credit rating came as a result of several concerning factors that have been bubbling beneath the surface. The erosion of governance, fiscal deterioration, and the ominous shadow of the growing government debt burden were cited as primary reasons for this downgrade. As the US grapples with these challenges, the economic landscape stands at a crossroads, and caution seems to be the order of the day. But despite the downgrade by Fitch, we think that the likelihood of the US defaulting on its debt remains very slim, given the catastrophic financial and economic consequences that would ensue. With that being said, we believe that this downgrade is mainly symbolic and it is unlikely to have any material impact on financial markets in the near term. However, we remain mindful of the negative impact rising government debt may have on the country in the long run. Aside from the rising debt to GDP ratio, the Congressional Budget Office also estimates that net interest outlay as a percentage of GDP could double by 2033 thanks to higher interest rates. The US government will have to act decisively before the debt burden rises to unhealthy levels, which could lead to adverse consequences in the long run. So in light of this development, we think that investors should continue to be positioned defensively. In terms of asset allocation, we continue to favor fixed income over equities, especially shorter duration, as well as investment-grade bonds. As for equities, investors should favor quality or value stocks over growth stocks, as the former may offer more resilience in an uncertain environment. This cautious approach allows investors to weather potential storms while keeping an eye out for the brightest investment opportunities that may emerge amidst the challenges. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Ming will share more about HSBC. Over to you, Ming.
Hi, I'm Timing, Research Analyst at Global Fixed Income. HSBC has had a good run in 2022, with its net interest income benefiting from the rising interest rates. We recommend its Tier 2 subordinated bonds and senior unsecured paper given its optimistic outlook in the near term. HSBC is one of the world's largest banking and financial services organizations, serving estimated 39 million customers across 62 countries and territories, which has a particular focus on Asia in the foreseeable future. Recently, a major announcement that HSBC was embroiled in was that its major shareholder Ping An Insurance Group wanted HSBC to spin off its Asian business into a separate listed entity given the better performance it had over the other regions. Unfortunately for Ping An, the plan failed to pass eventually as Ping An was the only major shareholder that voted for the spin-off, where the rest did not during its annual general meeting. Another significant development earlier this year had been HSBC's acquisition of SVB UK arm in March for $1 UK pound. The acquisition allows HSBC to tap into a rapidly growing field of innovation companies, particularly in the technology and life science sectors for its UK business. Coming to its financial highlights, HSBC benefited greatly from the rapidly rising interest rates in 2022, which allowed for increased net interest margin. For FY 2022, the net interest income is at the highest in recent years at 32.6 billion, a substantial increase from 26.4 billion in FY 2021. Looking at first quarter 2023, net revenue continued to rise by 38% from fourth quarter 2022, mostly due to significant rise in other income, which includes part reversal of funds impairment plus a provisional gain on the acquisition of SVB UK. But even excluding for those, HSBC still saw a significant rise in profit before taxes by estimated 84% from fourth quarter 2022. It had experienced positive jaws in first quarter 2023, which ultimately it sees improved trade income, lower operating costs, and loan loss provisions. Looking at the near term, the interest rates environments will likely remain favourable for HSBC. Most regions continue to see sticky, elevated inflation rates, calling for higher for longer policy rates. At the same time, we believe the capital reallocation towards Asia should support longer-term profitability, while the group continues to dispose of its subscale businesses. We expect HSBC to remain profitable with the continued earning strength in the near term. Coming to its credit profile, we have seen a good growth in a CET1 ratio thanks to organic capital growth, while customer deposits have increased after the banking crisis in the first quarter. HSBC's HQLA remains strong, covering estimated 51% of deposits, while around 40% of it are in cash. Overall, we see efforts by HSBC in managing its capital and liquidity highly necessary in this economic environment and exacerbated by the whole banking crisis. HSBC's credit profile remains resilient for now, although prudence will be necessary to manage further credit losses. For Tier 2 subordinated issuances at similar relatively good credit ratings, we like both HSBC 5.3% and HSBC 5.25%, while both are at a slightly lower yield as compared to BNP Paribas and Crédit Agricole. We are more optimistic about HSBC's outlook given the legislation in France that limits the bank's ability to capitalize on rising interest rates. For investors looking for safer options with lower risk of loss absorption, we recommend the senior unsecured HSBC 4.5% with a credit rating of A- and A+ by S&P and Fitch respectively. Overall, we favour HSBC for its ability to capture opportunities in the current economic climate, while at the same time, it continues to hold a relatively resilient credit profile, which is crucial for stability given the uncertainty in this period. That wraps up for the sharing of this week. Catch us again next week for more investment ideas and updates.